Greetings, plan sponsors, and welcome to the next edition of Marquette Associates Retirement Basics. I'm Lauren Cellucci, consultant, and I'll be guiding you through the webinar, covering all you need to know about the world of stable value funds and the significance of the investment to your plan and participants. Today, I will be reviewing an overview of stable value funds. I will cover the less understood and sometimes overlooked put provisions and competing product clauses found with these types of investments, and the fiduciary responsibility you have as a plan sponsor in selecting a stable value manager. Lastly, I will cover recent trends and litigation, as this asset class is by no means immune to the increasing trend of litigation we see nationally impacting retirement plans. What is a stable value fund? Stable value funds are designed to preserve capital, meaning a less risky investment that provides steady, hence the stable and stable value, $1 NAV with an income return. Since the funds are ultra-conservative, it does not experience strong swings in the market value, similar to the equity market. It's a desirable investment for participants seeking a low-risk environment while receiving predictable income. Stable value funds are offered in 401ks and other retirement savings plans, which means investors cannot access stable value funds in the retail market. So if you ever venture to find a fund for your own personal assets, say through a bank or broker, you will be unsuccessful. The stable value fund is invested in a high-quality fixed income portfolio, but what makes the investment unique is interest rate volatility that is protected by wrap contracts from providers such as banks and insurance companies, which leads me to continuing on to the investment structure. There are two key components of stable value return. First, return in the form of yield, and second, principal protection in the form of a stable NAV. Driving the returns of stable value comes from the underlying investments in short to intermediate government credit strategies to diversify risk. The underlying fixed income is typically of high quality in double to AAA rated securities, and the portfolio is managed by the stable value program provider and/or external asset managers. Portfolios can have as few as 1 and as many as 10 managers. To keep principal from market value fluctuation, wrap contracts provided by insurance and banks help preserve principal and provide a stable return pattern. However, providers retain a unique 12, 24, or even 36-month put provision. As plan sponsor, if you've ever decided to replace or terminate a stable value manager, chances are your stable value fund is subjected to put provisions. Put provisions protect contract providers so they can limit significant losses that could be experienced if a large number of plan sponsors or assets leave at the same time. If they did not limit significant outflows, the NAV could fall below the steady $1 mark. However, in some environments, the fund may allow some plan sponsors to exit earlier without waiting for the entire put period. Also, participants are freely able to get in and out of stable value funds as they see fit, and this makes sense since smaller individual investors are making independent personal financial decisions to exit. It's more unlikely that numerous participants will leave the fund at once. Well, what about in the case of bankruptcy and mergers? Or can't we just tell participants to withdraw all their money from stable value? No, as these are considered an employer-directed event that will cause mass transfers out at one time. Even re-enrollments can be subjected to put provisions. And this is why I encourage you to work with your record keeper and consultant to understand put provisions of stable value assets within your plan. Are stable value investments risk-free? Absolutely not. We saw during the financial crisis unique cases where stable value funds produced negative returns. The immediate impact of the financial crisis resulted in wrap providers, especially banks, exiting the marketplace. In turn, a number of stable value managers exited the business because they could not get wrap coverage. However, the stable value marketplace has significantly changed since then, and a number of safeguards have been put in place. Costs for wrap contracts have increased, reflecting the greater need to hold more capital to protect themselves from risks during crisis times. The investment guidelines are now more stringent to avoid fixed income with longer duration and higher credit risk. And some providers have extended put option provisions from 12 to 18 months in extreme market environments. One area not mentioned that protects stable value managers is competing fund clauses. Another way to avoid significant outflows in stable value funds and penalizing long-term investors, stable value funds have enacted competing option provisions. The competing option provisions prevents a mass exodus out of the fund, say if interest rates increase, to other accessible products that are more attractive. Usually, it's just limited to money market funds and bond funds with durations of under 3 years. However, self-directed brokerage has become a target too. Stable value funds may allow competing products if there is a delay of around 90 days before leaving the stable value fund and going into a competing product. So, with all the hassle of put options and competing fund provisions, complexity, and expenses, why should we add as a plan option? If you look over the past 10 years, stable value funds have outperformed money market funds substantially. Stable value utilization has been popular due to low interest rates and participants' desire to have a conservative but positively yielding product. Money market funds are yielding close to 0%, which has affected participants in search of yield. Stable value funds are not immune to the ever-increasing litigation seen in the 401k world. I've included a few examples here. In 2020, the Ortiz versus American Airlines, American Airlines 401k offered their own credit union deposit fund, but not a stable value fund option. Plaintiffs claimed American Airlines breached their fiduciary duty. However, the court dismissed. We do see instances where they were successful. In 2017, JP Morgan paid a settlement for investing its stable value funds in risky mortgage debt that caused significant losses. And in 2014, Lockheed Martin settled. The stable value fund invested most of their assets in money market funds, causing underperformance relative to inflation, along with excessively high fees. That's why we urge plan sponsors to document when deciding to hire a stable value manager and to do your homework. You'll need to examine and document wrap contracts and diversification. Many stable value funds now have multiple wrappers to decrease exposure to any single guarantor. You'll need to document the analysis performed in selecting a stable value fund, looking at yield, duration, credit rating, fees, and so on. You'll also need to understand the put provisions of the stable value fund and also understand competing fund clauses and the impact on the plan lineup. Thank you for tuning in to our overview of stable value funds. We hope you now have a better understanding of the asset class for your retirement plan. I encourage you to contact your consultant if you would like more information on what was presented today. If you enjoyed this video and want to hear more future webcasts, be sure to hit the subscribe button before you go. Additional information can be sent directly to your email by registering for research email alerts on the Marquette website. And thanks again for watching.